Our next presenter is Owen Bigland. Owen has been an investor since the wee age of 18 when he purchased his first stock, Pepsi, a stock that he still owns today and he has added to many, many times over the years. Owen has also been a longtime real estate investor by buying his first investment property over 30 years ago, and that was a one-bedroom condo in Richmond, which he still owns today. He would classify himself as a buy and hold investor, buying mostly blue chip dividend paying equities that also have a very long-term track record of dividend increases. He likes to focus on what his stock and real estate portfolios are producing in the way of passive income, opposed to being focused solely on price and the day-to-day valuations and fluctuations. Owen is also a published author. The book is called Along for the Ride. It's a great book on passive income. I have a dozen of these books, so if anyone wants them, contact me and I can mail one out to you. Again, it does a great job talking about passive investment and in both real estate and equities. Owen, are you there?
Turn my microphone on. I'm here. Can you hear me?
Yes.
Great. Thanks very much for the introduction, Roland. Thanks again for putting on this evening. Really enjoyed the first two presenters. That's the thing I love about these type of things. We're going to get all kinds of different ideas, real estate, passive income, stock market, all that good stuff. So I'm always interested in hearing other people's perspectives and learning some new things tonight for sure. So what I'm coming at, even though I'm a realtor here in Vancouver and I work with a lot of investor clients and I've built up a pretty good size real estate portfolio over the years, I'm going to come at you something tonight a little bit vanilla, but bear with me on this. I think this ETF, which is XEI, which is the TSX High Dividend Index ETF, it's kind of vanilla, but it's something that I think everyone should have in their portfolio. I call this kind of a foundation holding for me. If you could turn the slide, Roland. So XEI is a low-cost ETF put out by iShares. It holds anywhere between 50 to 75 stocks. No stock has more than a 5% weight, and no sector has more than a 30% weighting. So if you look at the holdings in this ETF, well, actually, sorry, I'll give you my disclosure here first. I've been buying this for many years, but I was buying quite a bit of it back in the big pullback we had here in March, April, and May, picking it up at around $13 and a half, $15 a share. I've been buying more of it at 17. It's currently, as of November 2nd, yielding about 6.38%. That's the current dividend. I hold this in all my cash accounts. Most of my TFSA and RSP is in US equities. That's another show for now. If you turn the slide, Roland, half of this portfolio is basically held in 10 companies. And the companies it's being held in are all blue chip names. We're talking Royal Bank, TD, Bank of Commerce, Enbridge, Suncor. It's really the best of Canadian, big blue chip Canadian companies. And the strengths for that is you're getting security in numbers. One click and you're holding 20 of the best Canadian dividend payers out there. It's currently yielding you 6.4%. The dividends, if you look at the PE ratios on these holdings, because many of these companies I own individually, like the banks and the Bell Canadas and the TELUS, these are trading at pretty reasonable PE levels. The dividends payout ratios are quite low on a lot of these holdings. So that 6.3, 6.4% yield is pretty solid. There could be some dividend cuts or some freezes, but overall, this is going to continue to give you a pretty solid yield year after year on this holding. And I think at the current valuations at about $17, $18 a share, there's some pretty good upside here. So the strengths on this is they're strengthened in numbers. You're getting 50, 60 companies, the best of the best, yielding you 6.3%. The dividend on this is paid monthly, not quarterly. So every month you're going to get a dividend payment on this. The management expense ratio is very low on this, 22 basis points, which is very low, less than 0.25%. And the current PE of the entire fund is at about 14.5. So again, fairly low PE. I think there's some good potential for capital gain over time on this at the current value. But the dividend on this, 6.4%, 6.3% is going to do all the heavy lifting for you here. So you hold this, I think, for the next 5 to 10 years, even with a very modest 2 to 3% capital gain every year, you're now talking 10% annualized return on this. That's pretty tough to beat. And that's why I recommend this should be kind of a core position or a core holding for most people, no matter what your age or your current portfolio, your net worth or whatever. Now, weaknesses, 28% of this fund are held in oil and gas. But the oil and gas plays in this are companies like Suncor, Imperial Oil, Enbridge, TransCanada Pipeline. Those stocks are pretty beaten down. That can be a benefit as well. Some of these are trading at pretty low PEs, and I think the dividends are fairly safe on these. Other weaknesses, Canadian economy, probably going to underperform the S&P 500. We're probably going to be in a recession here for the next few years. And of course, there's still a lot of uncertainty around COVID and what that's going to have on impact on the economy and jobs. But I do think if you look at the underlying holdings in this, as I say, TD, Royal Bank, Bell Canada, TELUS, Enbridge, Bank of Nova Scotia, Canadian Manulife, Sun Life, Algonquin Power, Brookfield Asset Management, Finning, Hydro One, Chartwell Retirement REIT. Basically, you're getting a lot of diversification at a low cost and a high yield here. Pretty safe. 30% in financials, 28% in energy, 14% in utilities, 12% in communication services, about 8% in real estate. So if you look at the individual holdings here, the PEs on the TD and the Bank of Nova Scotia and RBC are very low. Real estate makes up about 8%. Those are trading at multi-year lows. Bell Canada, TELUS have a long commitment of keeping and growing their dividend. Suncor, I think, could see some good price appreciation. I think the pipelines are more toll carriers more than anything. Dividends are fairly safe with those. I expect COVID will end, and I could see some good appreciation in this fund going forward. As a matter of fact, I sent this to you, Roland, early last week. XEI is up about 9% here in the last week, but it's still well below its lows. So again, I think when you can get a 6.2, 6.3% dividend, that's pretty safe. Add in, another 2 or 3% on top of that, very conservatively going forward as far as capital gain. Now you're cooking with 10%. Final thing I'll leave you with here is the nice thing with a form like this is that we're going to see lots of different ideas, and there's never one size. It was tough for me just to come up with one selection here. I want to just at the end here just talk about a minute about real estate as well, because that's my main investment area. But there's no one size fits all for investors, and what might be suitable for one person might not be for another. If you take a company like NVIDIA, that might be a fantastic stock for a 20-year-old in his TFSA, but might not be too good for a 70-year-old retiree because the stock is up 400% and it could get cut in half here. So not good for everybody. XEI, on the other hand, I think is suitable and is one of those core holdings that most people should have. And a couple other ways this might come in. I have always kept an emergency fund. Most financial advisors will tell you to keep, 3 to 6 months salary in a bank account or a fixed income of some sort. Lately I've moved pretty much all my emergency fund into something like XEI here that's going to pay me, 30-fold what a bank account is. 3 years ago on a high interest account, I was getting 1.25%. Today I'm getting, last I looked, 10 basis points. It's just too pitiful for me to put cash in there anymore. So a holding like XEI could be quite good and I think quite safe as an emergency, as a cash fund, where you're going to get some capital gain and you're going to earn a 6.3% dividend. The other area where I'm starting to use this. I get a lot of clients who will ask me, they're saving for the down payment on a house, principal residence, or an investment unit. They're going to need 20% down. I've always told them to just put that in a bank account or a term deposit. But depending on the time frame, if someone comes to me now and says, I'm looking to buy a house, it's a 3 to 5 year time frame, I'm starting to tell them they may want to look at putting maybe half of every dollar into something like XEI. Only because bank accounts are just paying such a pittance these days at 10 basis points if you're lucky. Something like this could be suitable for saving for the down payment, provided you've maybe got a 3 to 5 year window there to save. If you're ready to buy in 6 months, I would just keep it in a cash account. Final thing I'll leave you with, if I've got another 1 more minute here, Roland, if that's okay.
Yeah, you're good.
Okay, I'll just talk quickly about real estate here. Just wanted to, because it's so tough to just pick one investment, and I really, last time we were able to do one real estate, one stock. An area that I'm keeping an eye on now in Vancouver is, as you guys know, I'm mostly focused on downtown Vancouver, east side, west side. An area that I'm starting to keep an eye on this winter would be small studio or studio apartments, junior 1 bedrooms, some without parking in grade A buildings. Now, there's some pretty good opportunity they're starting to surface right now that I've been keeping an eye on some good grade A stratas downtown. And these would be studios, large studios, 560 square feet, no parking, in grade A buildings in areas like the West End. High-end buildings, concierge, air conditioning. We're talking buildings that have $3, $4, $5 million units in these towers. You're getting a loss leader in the $550K range. And these are off about $40,000 from where they were a couple of years ago. This area has been very hard hit with COVID, these smaller studios and junior 1 beds, because they were students that were renting these. They were corporate rentals for a year or two. Some of them were short-term furnished rentals. COVID has really put a big damper on that market, and a little tougher to get tenants in those right now. Prices have been coming down and inventory has been going up. Pretty good area to keep an eye on this winter, because there's some units now that you can purchase for under $1,000 a square foot. These were renting at $21,000-$21,500 a year ago. A little bit of choppy waters here until COVID is over, but it'll end. The borders will open up. The quarantine will end. Students will start coming back in. Corporate rentals will start kicking back in. So for a long-term buy and hold, if you can buy one of these at $1,000 a square foot today in a grade A building, and that's the key here too. Don't just buy anything. There's a lot of dogs out there. These are grade A buildings that are well off their highs. These could be easily renting back up at $2,200 a month in another 18 months from now. So pretty good area to keep an eye on in these studios and junior 1 beds for downtown right now. That's it. Hope I didn't go over time. Thanks for having me today.
We have more graces today with time, as there's 2 presenters that couldn't make it today. So I've let everyone go over. I think you were like 14 minutes, buddy, by the way.
Oh, sorry.